Hi, everyone. Welcome to our discussion today on the Veritas Next Edge Premium Yield Fund and discussion on, Canadian equities and market outlook, which Anthony from Veritas is going to give us some input on. My name is Rob Anton. I'm president and one of the founding partners of Next Edge Capital. With us today is Anthony Scilipoti, president and CEO of Veritas. As well as Eden Rahim, who's portfolio manager and option strategist at Next Edge Capital. The focus and agenda for today is we're going to provide an overview of the Next Edge, Veritas Next Edge Premium Yield Fund and some of the key attributes of it. Anthony's going to discuss, about Veritas, which is kind of the engine behind this fund. What they do, what they stand for, over the past 20 plus years. We're going to pass it over to Eden, who's going to discuss the overlay option strategy on this portfolio, which aids in the extra yield that this fund spits out. And then we're going to end off with Anthony kind of providing some of his comments, and Veritas's comments on the markets, some sectors in general, and general portfolio positioning within the fund and where we might be a little bit different. I'll start off just very briefly on, about Next Edge Capital. So for those that are a little less familiar, Next Edge Capital is an asset management firm. We were formed about just over 8 years ago as part of a management spinoff from one of the largest hedge fund and alternative firms globally called Man Investments, whereby we set up the Canadian business for them in 2006. Myself and my two partners have, vast experience at starting out building and managing asset management firms over the past 22 years, and are very surrounded by a very experienced team with similar backgrounds and pedigree. Although our fund lineup, which you can see on the right of the, screen side of the screen, seems to be very different to one another. Each fund has a very strong kind of core underlying thesis on why it was launched in the first place. So as opposed to us going out saying we need to kind of come out with a fund, of this nature in order to have in our lineup, why we come out with a fund is we think it actually has a very strong investment thesis on why it should generate returns or risk-adjusted returns, for quite a period of time on a go-forward basis. With regards to the Veritas Next Edge Premium Yield Fund, our thought process here is that fundamentals matter. Over the past decade or so, we've watched hundreds and hundreds of billions of dollars being placed into passive ETFs with no rational thought being placed towards, metrics, of any sort, that in the financial world, we were told that mattered. Things such as price to earnings ratios, book values, cash flow, and so on. So, this fund is really the opposite of that. It's, where fundamentals do matter, deep due diligence, really matters. And as Anthony will mention, finding the truth. We also believe that actually we're going to go into an era whereby stock pickers, we think, will actually be favored and outperform, the general, buy the blind market exposure, at all cost type situation. So, a couple of reasons anyways why we launched this fund. In an effort to expand our, yielding offerings in a lineup, we began speaking to Anthony and his team over at Veritas, about over a year ago about creating a product together. I've known Anthony for over 20 years and have the utmost respect for, what he and his firm, have built and really what they stand for. And I'll let him kind of tell that story, but independent, in-depth research, his firm's trusted by some of the top institutions, not just in Canada, but in some parts of the world, and research that actually now for over 2 decades has shown to add significant value. And it is their buy list, from which, equities are selected that go into this portfolio, which we'll talk about a little bit further. We've married, the Veritas engine, which is, where the equity portfolio is derived from, in this portfolio. We've married this with, an in-house team, led by Eden and, along with his partner, Mike, that each have over 25 years of experience in option strategies and yield generation strategies, from options. And, they're responsible for managing the overlay strategy on this fund in order to, derive some extra yield in the portfolio, which, the target will be 5% net, on an annualized basis. Some of the key points of which we're trying to attain from this fund, derived from, the very intensive research, based diligence on equities. We believe that, fundamental based research will provide some downside risk mitigation from the picks themselves. We think further downside risk mitigation will be achieved by the option overlay strategy, which we'll talk about in a little bit. So that's kind of key. We've mentioned a little bit about Veritas, and Anthony will go through their story on why we think their quality and the value added that they bring to the table from the equity selection side. And, and then with that, combined with an option overlay strategy, we, in addition to the regular dividends that this portfolio of equities will have, we are targeting a net dividend distribution of 5% annualized, which, in the first 4+ months that we've had have been very easily achieved. So with that, I'm going to pass it over to Anthony from Veritas to kind of go through the Veritas story, what they stand for, where they came from, and some of the value that they've added over the past 20 years of doing this. So pass it over to you, Anthony.
Thank you. Thanks very much, Rob, and thanks everyone for joining us. I have to tell you, I'm really excited. I'm excited because of the market that seems to be coming our way. As you alluded to, it's becoming more and more of a stock picker's game. The Fed put, as it were, is gone, and therefore riding the wave of just passive investing, I think, is not going to be so easy. And I think the positioning and the timing for this fund is going to work just perfectly. A little bit of background on Veritas. Unique in that we grew out of a forensic accounting practice. Some 25 or so years ago, I was teaching at York University and teaching accounting, and one of my students that had been in class with us before, he said, "Can you guys write about the ideas we were talking about as examples, things like Lowen Group, Laidlaw, Newcourt Credit, and so on, and showing how they were all cheating on their accounting, they weren't generating cash, et cetera, et cetera." And, what started out really almost for fun on the side of our desk in 1999, writing about IMAX, TLC, the Laser Center, Royal Group Technologies, and then finally Nortel commenting in February of 2000 saying that, they're not generating cash. We don't believe the multiple makes sense and we don't trust their accounting. It created quite a stir. And that stir really put us on the map. We didn't know it at the time. We didn't know how much of a stir is caused when you say sell in Bay Street. That's the 4-letter word that nobody wants to hear. And in our view, when we think of research and when we think of providing advice, we think there's only 2 decisions an investor needs to make. They're either adding to a position, in which case it's a buy, or they're reducing their position, in which case it's either a reduce or it's a sell. And so we think of investing as an absolute game. It's not relative. And so we've made our mark over time really by helping clients avoid bombs. And what I've learned over the last 25 years, the market's rigged to go up. When it doesn't go up, the Fed, the government will call its friends to buy stock, will lower rates, will buy bonds, will buy stock, whatever it takes to not let it go down. And so if we can just avoid the ones that go down, as strange as that sounds, and as simple as that sounds, and to borrow from, of course, Warren, it's simple, but not easy, we're going to do really well. And so we have a team of 15 analysts that we've built a track record. And Rob, if you can just flip through here, writing research. And why I'm excited about The
Where did you want to
timing.
go, Anthony?
Yeah, right there.
Okay.
Sure. No, go back to the performance, to the past one. That's good. Yeah. So we built a track record of our buys outperforming the index, and that's what this chart's showing, by about 350 basis points, and our sells underperforming the index by about almost 500 basis points. And that's cumulative aggregate over the time of each call since we started some 23 years ago plus. And, I'm also excited, as you're listening here today, many of you have never had access to Veritas research, Veritas products. And that's why I'm excited about this relationship, because we bring the bottom-up research fundamentals and the stock selection, and Rob's bringing the marketing power, the exposure to other platforms, and the trading abilities, so that we can put together a fund that I think is delivering income that investors are going to need in the coming years. And so when we look back at our track record here, and so that's the buys. We've won some awards, Rob. If you just show those, each our analysts winning awards here, and the Star Mine Awards over the years in various different sectors, our guys being able to outperform. We've also won some Top Gun awards on the next slide, you'll see. And if you go back, really our methodology, if you look at the chart there, is about, change the slide, is about separating facts from stories. And unfortunately in this market, that's what we get sucked into as investors. We get sucked into these stories. And so we believe that by digging through and finding facts, we're going to help clients avoid things like Yellow Pages, Valiant, BioVale, BlackBerry, and so on. And now I think, what I look at today's market, and we're going to talk about that a little bit more, but all the big tech names, we've been warning about the Shopifys of the world and of the other big tech names in Canada that have gotten hurt. We've been warning about financials, and I'm going to talk a little bit more about that. But those type of decisions are what allows us to position portfolios so that we can ensure that we're avoiding that downside capture. And if you look at the next slide, our research has been exclusive to, I'm going to show you my partner there, Sam LaBelle, who I've been working with. He likes to joke around. He's been married to me longer than his wife. It's now been 18 years that we've been partners. And he was our head of research for 5 years, and before that, or 6 years. And before that, he was our analyst covering oil and gas. And we've been exclusive to RBC, so no other IA platform in Canada on the bank-owned IA platforms could have access to our research. So this opens up a whole new gamut for us by partnering with NextEdge. And so what I did when we thought about putting together the asset management arm back in 2017, when we launched 2 products, we launched the Canadian equity and we launched the liquid alt, was we brought Sam over, and he was our head of research, most experienced looking at our research and as a head of research. And we put together what I think is a killer app to be able to put together portfolios. So thanks for this opportunity to work together, Rob.
Yeah, perfect. So we launched this fund June 28th of this year. Off to a decent start. I thought what I'd do is, Anthony gave some background on Veritas, what they stand for. If there's one question I would maybe add, or ask you before we move on, Anthony, but, you have a lot of institutions that, kind of very well recognize that, trust you guys for the research that you provide, the value-added research. Can you maybe mention some of those names? If people
sure, Canada's largest pension funds, whether it's the Case or Teachers or Mackenzie or CI or the global asset managers at the banks and smaller institutions and family offices. These would be our client base. In aggregate, there's about 75 clients and managing over $2 trillion in assets. And that's why it's unique that we have this asset management arm, because it's really research driven. It's research first. We're getting paid for our research. The stock selection that goes into the portfolio constructs is just layering risk management, portfolio weighting and timing on the decisions that our analysts provide us with. So,
yeah. Perfect. Thanks, Anthony. As well as some regulators.
Yes, the regulators like the OSC. That's right. CPAB, the auditors of the auditors. That's correct.
Yeah. So, obviously we like our partnership as well, and we're quite excited about this fund. So to kind of put into context what we're doing here with the fund, the core engine of where the equities are derived from is from Veritas, their investment research, as well as we work with Anthony and Sam, to kind of whittle down, their investment universe of things they cover. This fund will invest in, a selection of their buy list. So, how we screen their portfolio is, we start off, every day with kind of their buy list and, they're informing us of any changes to that buy list, and then whittle that buy list down to based on a few factors, such as things such as whether it generates a dividend yield, whether it's we have an ability to generate yield by doing an option strategy over it, or based on the conviction that Veritas and their team have on it. So we whittle that buy list down to a list that's a touch smaller than that, typically between 30 to 50 names. Is the size of the portfolio. Currently that's 35. And then and part of that analysis on whittling down the portfolio comes from not just Veritas, but Veritas in discussion with Eden, his partner and a few others, to determine what's the best fit within this portfolio. But it is all derived. All the equities in the portfolio are on the Veritas buy list, and it's worked with together to screen it from there. From there, an option overlay strategy is put on the portfolio in order to derive some extra income. The best way for us to explain that is to pass it over to Eden Rahim. So I've known Eden actually for quite a number of years as well. He actually apprenticed one of my best friends from high school who, at Royal Bank Investment Management 25 or so years ago, of which he's actually still at Royal Bank Investment Management and still talks about Eden.
Never told me that story. That's a good one.
Good things, Eden. Good things. In addition to being, a fund manager for in excess of 25 years, as well as a hedge fund manager, Eden also has experience for over 25 years at doing, overlay strategies through options and other derivatives. Starting back at Royal Bank Investment Management, where he also ran portfolios, but was doing similar type overlay strategies on their portfolios, as well relevant to what he's doing on our portfolio today. This fund is, Horizon. He actually, was a key person and was the person that Horizon started their cover called ETF business around, whereby, at the end, he was managing 14 covered call ETFs for Horizon. And, with us, there's two funds that he runs a similar mandate as far as an option overlay on. One is a sub-advisory mandate we have with Purpose on a global healthcare fund, which he does a similar, buy rate strategy on. And then this fund, which we launched at the end of June. So I'm going to pass it over to Eden. Obviously your partner, Mike, both of them are in-house NextEdge, teammates. And Mike has similar level of experience, although he was actually a person on the other side for quite a few of those years, executing your trades, and then became a number of years ago. But why don't you explain kind of the thesis behind how you do the overlay strategy, Eden? Because I think that one comment that comes out there quite a bit is return of capital. A lot of times, some of these option strategies can deliver yield, but it comes at the cost of grinding NAV. Explain your philosophy, and then I might have a few follow-on questions.
Yeah, sure thing. Well, thanks, Rob and Anthony, and delighted to be working with Anthony, well-respected forensic accountant in the industry, and thank you very much for joining us on this webcast on the Veritas Fund. First of all, just, most of us are familiar with an option overlay to enhance income. The traditional portfolio, equity portfolio, there are two sources of return, basically capital gain and dividends. But what we try to do with a dynamic option overlay strategy is add two additional sources of return. One is you exchange a bit of the capital gain for the greater certainty of earning a monthly option premium. Any option premium earned in excess of that gets reinvested back into the NAV, so you end up helping the NAV as well. So there are two additional sources of return that you're trying to not have to rely almost exclusively on capital gain. And as Anthony mentioned, the halcyon days of the past decade of zero interest rates, unless you believe we're going to have a rip-roaring straight-up bull market, an option overlay might be almost entering its nirvana period, where the market either meanders sideways for a lengthy period of time, drifts down, rallies a bit, rallies more gradually, and it works best under conditions like that. And we may have conditions like that where active management and excellent research from the likes of Veritas, excels, where passive investment that have benefited from Fed zero interest rate policy has dominated the past decade. So we might be entering that period. And again, the intent is have your stocks, which you like for their fundamental virtues, earn a rent in that period of time by writing shorter dated options, which decay more rapidly. So my optional overlay strategy was actually, as Rob mentioned, developed over 2 decades ago at a major institution. And it was overlaid across billions in assets. And we don't do option overlays the way other firms have approached option overlays in the past. We tend to focus on shorter dated options that have a higher rate of decay. We tend to be more active. We don't hold them to expiration. We'll cover them when they're down 80% and rewrite again. So we have the stocks earning that rent constantly. But most importantly, we write out of the money. And specifically, we try to write about 1 standard deviation out of the money each month. And so what that means is that it allows your stock to appreciate by what the market's expectation that it could appreciate or swing in the course of a month. And that's good volatility, right? If the stock can go up a certain amount based on market's expectation, that's good. And then it gets capped off there. And that's where you've earned your capital gain and you've earned your rent. And so we think it's an ideal strategy for the sort of markets that we see going out over the next many years, as obviously the cycle transitions from that zero interest rate bubble into a higher rate, higher inflation type environment. So our strikes are determined dynamically. It's not just a fixed strike. We're not writing longer dated options, which get hurt in a higher volatility environment. Again, we stay short, try to generate much more. And again, you're earning a higher yield without accepting credit risk. That's really one of the virtues and attributes of the strategy. Specifically in the Veritas fund, what we do is we don't write across all names. We sequester the portfolio, let's say, into 3 buckets. The higher volatile names that are low yielding, the medium volatile names that have some yield, and the high yielding names that have low volatility. We tend not to write on that 3rd bucket, and we tend to write more actively on the 1st bucket because we generate much more option premium. And so they do more of the heavy lifting in generating the additional option premium yield. And that was basically an introduction to what our approach is as far as Veritas is concerned.
Yeah, and if there's one thing I would mention as well, Eden, that you did mention you're active, but there's definitely been times in the first 4 months that this fund's been around whereby within a course of a week and a half, a 1 month option might have reaped 75 or 85% of its premium.
Yeah.
Instead of just holding it for the last 2.5, 3 weeks until expiry, why not actually just, close that position out, look for an opportune time to rewrite it, which is something you've done quite actively. So it's, you're not just getting, someone, just with no rational thought putting these options on. They're very actively managing this option book to add a lot of value from it as well.
That's correct. Again, we want each position to be earning their rent constantly, benefiting from the higher volatility. Because again, in this environment, volatility is an asset. We don't look at it negatively. We actually like it. We actually anticipate it. And our aim is to turn that volatility into a source of return.
Yeah, perfect. So with regards to this portfolio, I mentioned as of current, there's 35 positions within the portfolio. That's probably ranged between maybe 34 up to maybe 42 or something like that over the first 4+ months. Current dividend yield is 2.42%. If you add in the yield premium generated from the option overlay strategy, the gross yield's over 6% and has been consistently over the first 4 months of the fund. Total return, including distribution, since June 28th, when we launched the fund, has been 5.2% till yesterday, so the end of October, versus 2.2% for the TSX index. And I will mention that the NAV on the fund. So there's a lot of backlash with regards to NAV grind. Within a lot of these covered call positions. Our NAV over the last 4 months is actually up 4.4%. So no NAV grind and quite a good cushion in there. So we think that our ability to generate net 5 over time is quite achievable. I will mention the one thing maybe I just didn't mention is that these positions are equally weighted within the portfolio. As far as general terms of the fund, it is a prospectus mutual fund with daily liquidity. Minimums are relatively low. We charge 80 beep management fee. So the F class, 0.8% management fee. At A class, we add a 1% trailer to that. Distributions are monthly, and that's kind of the fund. So, the key aspects of the fund, just to reiterate, capital preservation focus, which is a combination of, very in-depth, fundamental-based research, which, the equities are derived from Veritas. Option overlay strategy, which further helps mitigate, some downside to the portfolio. Consistency of returns, combination of dividend yield plus, the option overlay will, allow this fund to achieve a net return consistently of, 5% net per annum, which we pay out on a monthly basis. And, as I mentioned before, it's, I believe we're going into a stock pickers market, and a market which, will reward fundamentals, and stock pickers and research. So we think it's a quality offering in the marketplace. So what I'd like to do now is kind of, bring it back over to you, Anthony, and maybe to start things out. I know you were going to give a little bit of your thoughts on the markets in general, and Canadian markets and, kind of likes, dislikes out there. What I have up on the screen, maybe to kick things off is, the current, portfolio sector weighting, of the fund relative to the TSX index, and how things differ. So you can kind of, one thing that you're definitely getting with this fund is not a closet index fund. It's, the positions are derived from the research. The research does the talking. And that'll determine whether we're underweight or overweight various sectors. So why don't we kick things off with the financial sector? Since we launched this fund in late June, we've tended to have under 10% exposure, to the financial sector in the Canadian equity markets versus, the TSX index, sector weighting to theirs typically been between 31 and 33% over that time frame. Significant difference. You've made some big calls on the banks, starting earlier this year. Maybe just start talking about financials, since it's something every Canadian talks about.
For sure, and it's near and dear to everyone's heart. When we wrote a report in February of this year, and we said, there was only one bank that we would own, and that was BMO. We got a lot of pushback, and it's not unusual for us. we said, listen, we're going into a period where I like to say it's one, to borrow from Star Wars, where the economy strikes back. We've been toying with the economy with low interest rates, buying bonds to manipulate and ensure that the economy doesn't do what, Friedland and Smith anticipated it to do. And so because we've been toying with it for really, probably 20 years, but very aggressively since the great financial crisis, we have penned all what the watershed moment was, what I'll call the COVID bubble, or will go down, I think, as the COVID bubble. And so what that did was it brought forward a lot of demand from the future. And it also made people embolden them as investors, as buyers of all assets, whether it was sheepdog coins, Bitcoins, tech stocks, everything. We had to own everything because all assets were going up. And that's just a function of free money, rates at zero, and federal central banks as a global force buying bonds. Okay, never before did we have such a concert of activity among central banks and governments around the world. What that did, okay, as I said, was you saw the inflation of all assets, okay, because discount rates change when interest rates go down. Well, now, because there's been all that demand that's taken place, and we had, of course, the shortage of supply, right? That brought up inflation. And so for the first time in really 4 or 5 decades, we're seeing inflation in many parts of the world in double digits. Not yet in North America have we seen double digits, but we haven't seen these levels in the 8% range and 6% ranges here in Canada since really the early 80s and into the 70s. And so what that means is that now I think there's very few investors that have the muscle memory to think about what it's like to invest in these kind of markets. When what's interesting, especially in the summer, when the markets really rallied hard through July and August, and on the back of, I guess, earnings seemed that they were okay. It was, they were the market anticipated the end of the world. The markets, results were okay, and then the Fed came out, Powell, and said, listen, did you not listen to me? I said that inflation's a problem and we're going to be raising rates. And everybody went, oh no. And so here we are again, where we've seen that it's hard to imagine. Normally in markets, and I think there's 2 things to separate here, the economy and the market. So I've mentioned how the economy struck back in that inflation is taking hold. And sure, inflation is going to come off, but to what cost? Okay. And in the meantime, what the market's doing is people are essentially saying, what I think is very unusual is we've seen the leaders, our FANG stocks, our Teslas, our, the champions of the markets, the Googles, the Microsofts, they've gotten killed, okay, on missing earnings, okay. Whether it's justified or not is another discussion, but they've gotten hurt, not just because of the multiple compression, but now also because their earnings estimates and revenue estimates were too high. That I don't think is done. But what is interesting is the market has sort of rallied back on the back of that contraction and hit to the leaders. I think it's, when we find out tomorrow, now I'm not sure what Pavel's going to say, but I got a suspicion he's going to come out. People are expecting a pivot. We've had strong economic numbers in the retail sales, employment numbers. GDP was positive. It actually beat expectations in Q3 after 2 quarters of negative GDP. So why would the Fed pivot now? And if we remember back, and I'm not suggesting this is going to happen again, but all we have to go back in history. You have to go back 40, 50 years into the 70s and 80s to see times when inflation was 12 and 15%. What did the Fed do? He raised rates to 15 and 20%. In other words, above those levels of inflation to deal with inflation. Now, I don't think this time we need to raise rates as much. So because the market, because the world is sort of working more quickly in concert to deal with inflation. So I don't think we have, and plus there's just more debt. So because of that, the impact of interest rate moves happens more quickly. But what I expect to see is that, while people think that the pivot's coming now, I'm not saying it won't come, but I think we're probably 2 quarters away from there being a pivot where you're going to see earnings estimates start to come down for Q4, and then estimates into 2023. Already, we still see, I think the last I checked, it was somewhere between 5 and 7% growth in earnings on the S&P going into 2023 from 2022. I think there's going to be some change to that as we move forward over the next few quarters. So what's all that mean to how we think about positioning this portfolio, right? If interest rates are going to stay high, we want to be careful not to just own names that are going to do well because of their yield, right? Because as interest rates rise and stay high, the value of said securities can get hurt. So when we think of holding names that give us yield, we think first of their stability and the stability of their cash flows, not just that they're paying out a significant yield. So when we think of a safety bucket, we have our consumer staples in there. So we have the Metros, the Loblaws, the Westons of the world. They don't give us as juicy a dividend yield as some others might, but they give us stability in cash flows and dependability of their earnings. And that's what we're looking for first. The yield will come after. Then in the case of utilities, similarly, we don't own all utilities just because they pay a dividend. No, you need to think first, is this utility able to grow its cash flows to sustain said dividend? So we like the Capital Powers, we like CU, Canadian Utilities as examples, okay? And then we look at some that might be undervalued, like a TransAlta, okay? That's how we think about creating stability. And so when we think about something that's going to give us perhaps some potential upside as the economy starts to pick up at some point, because we are coming out of lockdown for sure. And so then we own things like Air Canada, we own Bombardier, we own Transforce. These are companies that, in the case of Bombardier, people, I think, I've misplaced thinking of what its balance sheet's like in the past. It's a new business today. The Air Canada coming essentially after being grounded, and you saw its decent results. So we're looking at those as being ones that we're going to manage the coming out, let's call it, of the improvement eventually of our economy. That's how we want to play it. We'll buy some Linamar, we'll buy some WSP to take advantage of some industrials. You can see our industrial weightings there. When we think of tech, we've been negative on Shopify for quite some time. And when we're thinking of tech names, we think of things like an EFN or a CGI, where you're getting stability again in its business, in its earnings, in its cash flows, and not concerned with high-flying multiple stocks. There is, and I guess lastly, I'll say, no one knows what the future holds. This is probably been one of the most challenging years for many of us that have had the pleasure or the challenge of trying to invest other people's money. What I can say here is that we're invested alongside. This is our business. It's a 100% employee owned in the case of Veritas, and I think the same thing for NextEdge. So this is something we believe in. It's concentrated. They're bottom up the way we decide the stocks that we're going to own. Doesn't matter what their weight is on the index. And when we think about weighting, we actually equal weight the positions. And the reason for that is, sometimes we can run all kinds of historic screens and say, historically this stock has tended to outperform this other one under these conditions, but the conditions are so different in today's market that when we look at it, we say, we're just going to equal weight them, because our analyst tells us that they like them all. They're all buys. So why should this one be a higher buy than the other one? We're going to think about differentiating them on the asset management side by writing calls or writing puts on things, by putting them into different buckets, whether we're not going to have calls and put or written on those securities. That's really the key. So I'd look forward here and I'd say, look, you have to be nimble as you're investing, picking stocks, and be careful, because if rates continue to stay high, I think higher multiple stocks continue to get hurt. Gold is going to have its day here. It's been under pressure for some time. We have a strong belief that that's going to do well. So we have a little bit of gold in the portfolio as well. And if anyone has any questions, I try to keep it tight here. But if anyone has any questions, or Rob, if you think I've missed something, I'm happy to address it.
Yeah, so please just, type them into your Q&A function on the screen. Any questions for, Eden or Anthony or myself. I'll start things off with maybe just one comment, Anthony, because, it's when you look at some of the macro, things that are impacting a lot of companies, whether it be, rising interest rates, whether it be, inflationary pressures towards companies, whether it be supply chain issues from some of the, global stuff going on. We've all, you mentioned this a number of times, and it's a strong belief of mine that, we're going into an era where stock picking matters, and really rising interest rates, inflationary pressures, supply chain issues impact, one company different than another. So it kind of, I think it definitely, it's not the only reason I think stock pickers are going to, evolve and outperform on a go-forward basis, but, analyzing each company, regardless of whether they're a big representation in an index or not, taking those type of things into consideration on whether to actually have a buy or a sell rating on them is quite important. So I don't know if you have anything more to add on that, but it's, some of these things are big reasons why you do want, fundamental.
I would say this way. So the moment that you have higher interest rates, what happens is, is now that changes IRR, the internal rates of return expectations, and changes the company's cost of capital. And so when that happens, then when you think about a company who today doesn't have cash flow, doesn't have earnings, if the expectations are for said cash flows or earnings to come 10 years hence, if the rates of if my hurdle rate is the 10-year bond at 1%, and in 10 years I'm going to make 200 times my money, or double my money, or 50% increase in my money, I'm willing to wait because the cost of capital is very low. Now that cost of capital has risen, it changes the calculation. It changes the dynamic. I no longer want to wait, which changes the valuation of said organizations that have longer dated cash flows. And you have companies like Uber saying, you know what, we need to now start thinking about our generating earnings, as an example. Okay. And I think that's going to be something that's going to change. You're going to start seeing, if the economy slows over the next quarter or two, companies are going to have to start cutting people, because if the revenue line slows, and we saw that in Q3, if that continues, then the only way to make earnings grow is to cut costs. And the simplest thing to do is cut people. And that's going to lead to the next concern that we have. And as unemployment rises, that could really have ripple effects on the housing market. We just finished our 10th annual real estate conference. And my biggest takeaway from market participants is that we're all smoking hopium, because we're hoping that interest rates don't go higher. And since our conference in the beginning of October, they've gone higher. We're hoping that unemployment doesn't rise. We're hoping that immigration stays high. All these things, no one knows what's going to happen, but they're all premised on ensuring that the business, that we don't have consumer losses. And if that happens, that'll really weigh on bank results especially.
Yeah. So, well, thanks, Anthony and Eden, for joining today, and everyone. everyone else that dialed in. If you have any questions, reach out to either myself or your local Next Edge representative in your regions. And, we're glad you joined today. Appreciate it.
Thanks very much, everyone.
Thank you.
Thank you very much.